Welcome, everyone. Welcome, everyone. It's Angelo Robles, and welcome to Family Office TV, and for my members, SFO Continuity. Today, inside the mind of a direct investing family member, sourcing and diligence on private companies. Our special guest today is Sam Casperson, trustee and LLC manager. And in today's discussion, I'll be talking with Sam about the economic benefits of investing in private companies, both as controlling and non-controlling interest, as well for some as being an LP investor. We'll also talk about sourcing deals, initial due diligence, letter of intents, legal nuances of negotiation, further deeper due diligence, industries that are attractive right now, and some of the pitfalls, but also advantages of investing in private companies. One of the potential advantages that we'll talk about is engagement of the rising generation. So on that note, I think we're ready. Sam, welcome to the show.
Thank you, Angelo. It's great to be here.
My pleasure. I think I hear the wonderful sounds of New York City in the background.
Yes, the natural habitat of Manhattan.
I don't hear that sound too much when I do my 3 or 4 months in Wyoming, but I don't know. I wonder why. Sam, why should families and their family offices even consider investing in private companies?
Well, it's a great question. I think it should start, of course, with portfolio construction and allocation. And if a family says we want to trade liquidity for some number of hundreds of basis points of greater returns, and we've kind of done a rational analysis on that, and we are going to do an endowment portfolio construction model, which could be as up to 50% or even higher in some cases to illiquid or non-public securities. It flows from that. I think there's obviously a major fork in the road right after that as to whether to do direct investments versus be a limited partner in private equity, private credit, other type of alternative investment manager partnerships.
All things we're going to get into, Sam, but I am going to assume there are obviously negatives investing in private companies, no matter what I do. If nothing else, compared to public companies, I'm not liquid. Therefore, what is justifiable of a return in what we deem to be a less efficient market? So I expect to get higher returns. Is that 300 basis points more, 400 basis points more, or more? For some, maybe 1,000 basis points. How do I make that decision that I'm giving up liquidity? I want to get an extra delta and alpha in my return.
It's a great question. There certainly is not a monolithic answer. Is the S&P 500 in the last 15 years been close to a 5x? Is that correct? It's
done very well. So that's part of the argument about a challenge in direct deals versus liquid public markets. Look at the triple Q.
So I think that the answer then is you have to make a decision. And again, like privates, there's as a limited partner with either large private equity or alternative investment managers, and you look at their track record, or middle market private equity is a huge category. It's almost too huge to think of as one category. So it's different families can have different risk profiles and different illiquidity tolerances for percentages of their portfolios, but just have to do the analysis yourself. And that is the process. I don't think I could give my own answer for what works for me, but that could be very different for other family offices.
And related to that and being sequential, of course, families and or their family offices need to decide if investing in private companies is going to be worth it relative from an investment policy statement and asset allocation perspective. And why do it if you're not going to get, in my opinion, what you deem to be a higher return? Now, we could talk about mitigating risk and all that, but I think that's I don't know. I don't know if I buy into that relative from the direct investing perspective, but the other nuances that come up, and there's several of them, but why don't we start with, I need to decide, am I going to be happy with non-controlling? And the hassles that go with controlling are now off my plate, or do I deem to be that I need control. Therefore, a controlling interest or certain measures in the agreement of the investment that I'm making where I'm on the board or I have significant decision power. How important is all of that in deciding between the two, non-controlling and controlling?
Well, I would back up a little bit and say, what is the overall plan and process for portfolio construction and allocation, and never look at any specific investment in a vacuum of your plan and process. Like one thing I've, as an attorney and as an investor, have observed, and unfortunately to be self-flagellating, have experienced, is like you say, there is securities fraud out there in the family office world, and of course otherwise. A very prominent recent example is Rupert Murdoch's family office invested over $100 million into Theranos. So direct private investment, and they got a zero on that, I believe. So because there was securities fraud. Now, so securities fraud occurs, that has to be part of any due diligence process. But what I'm saying right here is what's much more common than securities fraud, I think, although I don't have empirical data, of course, is investors lying to themselves that they understand the risk, that they were positioned to actually do the due diligence, that there's the kind of the legalese that we've all read 1,000 times. You understand that investment is not only illiquid, but you may never get back your capital, let a return on investment, and you are prepared to lose your capital. So the number of times I've seen people who, it's one thing to see it in the abstract at the beginning of an investment, but then people react very differently if they actually lose their money. So I would say just at the very beginning of this conversation, don't lie to yourself about what you're endeavoring to accomplish. Don't allocate to direct private investments because it's boring to be at a cocktail party and discuss your LP allocation to Blackstone Infrastructure 7. But it'd be more exciting to talk about an exciting early stage investment that could 20x. So don't lie to yourself. The best way to not lie to yourself is to have a plan and a process in place for assessing any specific investment, and you apply your plan and a process to that opportunity. So that could be that you start with, like portfolio construction and allocation. We are going to be 40% into illiquids. And then out of our overall 100%, including that 40%, 5% will be allocated to venture capital. And of that 5%, we will allocate 20% of the 5% or 1% of the overall portfolio to directs that aren't through a VC manager. And of that 1% of our overall portfolio, we will have 10 investments. So in other words, we will make 10 direct investments into early stage private companies directly, and each one of those they'll average 1/10, 10 basis points of our overall portfolio. Like that's a process. That's a detailed process, and you look at specific opportunities within it. But you still have to ask yourself, if you're doing this for risk-adjusted returns and for portfolio construction and allocation, do you think you're going to do better than VC managers? Why do you think that? You've decided you want to allocate 5% of your overall portfolio to VC. It's a pretty big allocation, perhaps. Then you want to take 20% of that overall allocation and do it in directs. Why? Why do you think you're going to do better than VC managers? And of course, the first question is, why are you allocating 5% to VC? So having a process in place for all of this, I would say, and then no decisions taken in a vacuum, that's the best way to start. And there certainly are arguments that are not just about risk-adjusted returns for doing direct private investments. It could be that you want the next generation to have some experience. And there are ways to kind of leg into that. For example, you could say, well, we're going to invest in VC funds in these areas, and we're going to ask to see, as LPs, all the investment memoranda. And that's like a really good educational tool, actually. And then we're going to experiment with independent sponsors in VC, where we're not just diligencing the manager, but we're diligencing the specific opportunity because it's all being allocated to one opportunity and there are no further capital calls. It's not a blind pool fund. And so you can have a process in place. It doesn't necessarily have to be about IRR overall or risk-adjusted returns. For example, in my family, when I was right out of college, my father would say, okay, the family foundation, you can allocate X dollars for the next few years to charities of your choice. I want you to own it in Diligence charities. That's pretty interesting. You could also do that with out of a foundation, for example. Say, okay, you next generation, you're interested in climate tech. Instead of you being able to allocate $250,000 to charities next year, you can allocate $175,000 to charities and $75,000 to direct climate tech investments that you source in Diligence. So that's what, and it's almost treated as a grant. You don't expect there to be a return on investment, but it could be a tremendous educational opportunity for someone who's in college or right out of college to go through that process. So that would be a reason to do direct private investments that are not primarily driven by portfolio construction and allocation and IRR, but you're still doing it with a very disciplined process and a very finite amount of capital being allocated to it. And both of those, like portfolio construction and allocation, or you're doing something different to, for example, educate the next generation, it's defined on allocation amounts and process. I think that and you're not lying to yourself.
That was a comprehensive answer, Sam, but it also brings up a lot of questions. So I'm going to roll up my sleeves and here we go. And this somewhat comes down to, like I said earlier, what is the investment policy statement? What's the allocation strategy? And what's going to be the focus in privates? Understanding the lack of liquidity. And I'm going to come back to a question that a lot of families overlook, where that comes back to bite them in the butt, where we're going to hold on to that one for a little while. And then, like you said, or I said, controlling or non-controlling. Do we have the internal resources to do either, especially being controlling? And I've learned in traveling the world that building a family empire over generation after generation after generation, I'm not going to say it's impossible to do it without actively engaging the rising generation and understanding private companies, how the world works, how negotiation works, how financing works, how it's not easy to hire and fire and make decisions, but that's what builds resiliency over time, even if some early mistakes in families. But you said a couple of things besides now my commentary. You mentioned VC. Not to kick VC. I love Silicon Valley. I love what's going on there now in AI. And I think there's always going to be incredible opportunities, but they don't necessarily, if you go by the statistics in the last couple of years, do such a good job. They fail, they swing and miss more than they succeed. I can make an argument that I'm going to invest in the triple Q, which I know is different than entrepreneurs. And just look at the math. I'm going to beat net of fees over 10 years. The vast majority of quote unquote VCs. And the VCs that are incredible, and of course there's some of them are huge, and I could be a family waving $100 million check. I am not getting in, period. So it's hard to get into some of the really, really good ones. But you're correct. What do I know as a family office in early stage entrepreneurs where most are going to fail, where I'm going to be better than a VC? I think that's a hard game to play. But if I'm buying profits, AKA competing against private equity, then I think that changes the paradigm, and that does make it intriguing in my perspective for a family to consider being a direct investor. So the other option that you brought up that I didn't bring up too much is very simply believing in the concept of private companies or thematic plays, becoming an LP investor. My problem with that is lack of engagement with the rising generation, zero control, zero tax control. And the reality is most of them probably have not really crushed their benchmark net of fees, where I could be arguably liquid in certain other benchmarks and portfolios. Therefore, Sam, you're a smart guy. We've done the math on 2 and 20. Like, you're paying a lot of money, especially on that back end. If it does pretty good, getting 10 or 11% a year, that you could divert that money, have control and some liquidity, and bring on an internal team without needing to be an LP investor.
Some of it depends on AUM, certainly. Like to run a real single family office, and that might cost $10 million a year. So do you have the AUM to justify it? And then you're going to kind of lift a private equity team out of Blackstone or something for middle market investing, because that's what you have to do. You can't. There's no monolithic answer. In my opinion, there are many middle market private equity funds and secondary funds that consistently achieve greater than 11% IRR net of all fees to LPs, and it's just less risky. So I would say, as a starting point, is if you're going to allocate a material percentage of a portfolio to illiquids, the very difficult to rebut default presumption should be that the vast majority of that illiquid allocation is going to alternative investment managers who have a track record of success that they've built, and teams and standard operating procedures that they've built over time. And then if you build your own team and standard operating procedures over time and you measure your success, you can slowly adjust the allocation from being an LP to being to doing more direct investing. And then there is, of course, the whole discussion of of control versus non-control. I think doing control investments, you need to have a real private equity team that's likely has experience at a larger private equity firm that you've lifted out of there, you've hired, or like you have an operating company. No, I know one single family office that was in aerospace and defense, as a specific example. They sold a large privately held company, family-owned company, to up the supply chain to the ultimate OEM, original equipment manufacturing company, in a very substantial realization event. And then they had this massive portfolio of liquid for the first time, and they hired someone who had been a very successful, first of all, an engineer in aerospace and defense, and then an investment banker in aerospace and defense. And they said, now we're looking to make non-control investments or sort of GP investments. Like, well, that family could do it in aerospace and defense the way another family could not do it in aerospace and defense. And that gets back to kind of not lying to yourself. So they were positioned to do control investments in aerospace and defense. They weren't going to do control investments in consumer packaged goods, because what was their advantage there? So it starts with, don't lie to yourself. It gets back to that. I don't know if that's a partial answer, but I would say, like, unless you have that type of specific fact pattern where you have deep industry expertise and a team that can deploy capital at scale and make control investments, then the difficult to rebut presumption should be whatever your overall illiquid allocation is, the vast majority of it will be as an LP versus directs, and much smaller percentage are directs, presumably are non-control or club deals. And then you can, over time, perhaps allocate as you learn to a higher percentage to direct deals.
Okay, I mean, I may go a little back and forth with you on that. And by the way, I'm loving the discussion. You're very thoughtful in terms of your responses. And as my audience knows, it's okay to disagree with a guest. I think it actually creates interesting dialogue. It causes me to have strong. I may have strong opinions, but they're loosely held. As new information comes in, I may need to adapt, and I hope my audience feels that way as well. What I'll say, and this first comment may apply more to larger scale funds, is a lot of them, when they start to get billions and billions, they placate to institutions. They don't care necessarily about families. They're often not even really looking for the majority of family office capital. They become a little bloated, a little hierarchical, a little bureaucratic. They could tend to have too much bloat in terms of their teams. I think they get somewhat lethargic. And often they kind of look to play it safe. Yet, now maybe that's more on the hedge fund side, but even on the private equity side, they now also have the situation of needing to deploy capital. Are they overpaying? Are they driving up prices? Maybe if I'm selling the business, that's a good thing. Now, I wrote years ago, and I know it was the magical perfect story about 1971, how Sid Bass hired a 26-year-old Richard Rainwater out of Goldman. And it's not like Richard had thematic expertises. He was a smart guy who was broad and was able to adapt depending on market conditions. So could I make the argument, and Nathan Troutman said this too when I had him on a couple of months ago, that you hire people that are smart, strategic thinking. They may not necessarily be a pure expert in a given theme or sector, but they're able to adapt and learn, see it from a different perspective of those that may be too lasered in on it. So I know it sounds like I'm hitting a little hard, the 2 and 20 model. Some of them are friends of mine, and some of them are utterly incredible in the work that they do. I just think that it's somewhat overblown how people make it appear that families with some level of resources and gumption can't do it themselves. I'm going to rephrase it a little differently, Sam. If I'm putting in 200 million into alternative private equity strategies and it's doing pretty good, 14.4% a year, which doubles my money in 5 years, that's a wicked back end 2 and 20 on that 20% that I'm paying. You're telling me that I can't find the right team where maybe I'm giving them a little less upfront, but unlike the fund they're working for now, I create a holdco where I'm giving them a part of the equity. So it's salary, bonus, carry, part of the equity, and you're an attorney, how I structure the holding company. What I'm basically trying to say is, no, I don't think you need to be, don't get involved in direct deals if you're not a $3, $4, $5 billion family. That may be true in certain sectors and industries, but I think in the majority, it is vastly overblown, in my opinion.
Okay, so I think you're discussing specifically direct control investments. Is that correct? And you gave the example of the Bass brothers hiring Richard Rainwater, which was at a time when the private equity class was really just beginning, and he sourced and executed at an extremely high level in what was a vastly less efficient market than it is today of private market opportunities. And Michael Milken and junk bonds that were just coming online, like all these things were happening it's a very different world today. Now, but I agree, that's not to say a family office can't find a really smart younger gentleman or younger lady and give some percentage to allocate. But and I'm not saying that's the wrong decision. Like, there's no monolithic answer here. But you mentioned gumption, right? So when I hear gumption, I think there's a higher risk tolerance. And I think if it's a family office where the wealth creator, who of course created wealth by taking concentrated risk, is still running the family office, it is more likely to occur than
100%.
Right. So it's to me, it starts what is our plan? Is this overall? Is this a defensive? Are we happy if we have a 10% return over the next 25 years? For many single family offices, that's a great result. They say, tell me where to sign up for a 10% IRR over the next 20 years.
Well, hold on, Sam. I'm going to push back a little bit. I'm surpassing that on historical averages in triple Q and S&P, and I'm totally liquid. What extra delta or risk mitigation am I getting in the example that you gave?
I don't know, but the unstated premise in your statement or question is that the environment will continue as it has for the last 15 years, which has obviously been a tremendous environment for investors and public markets, especially. Like, what happens if we have a war with China, right? Like, we could be in a vastly different environment. So past performance doesn't.
Well, then I maybe go gold and other things. I don't know.
But this is part of portfolio construction. So it's
sure.
And like you say, like what is, like, just, I think a good metaphor for investing is being an airline pilot. And no pilot, you need to have a pilot, a co-pilot, a navigator. There's very detailed checklist. You do not take off unless the whole checklist is met. You have the discipline to say, we're not, the engine maintenance hasn't passed these very specific tests. We're not flying today. Now, another plane with another crew and the same engine issues, well, they take off and they reach their destination. Did the first crew make a mistake because the second plane didn't crash? I don't think the first crew made a mistake. So maybe their IRR is lower but they had a process, they had a plan, and they had a risk tolerance, and they executed on it. In a way, what you're asking is, well, why shouldn't family office have a higher risk tolerance and go for a 14% IRR instead of a 10% IRR? I think obviously the issue is, in many cases, the 10% IRR is achieved with just as much risk as the 14% IRR. Like, that's the delta or the disparity you're trying to find, the arbitrage, where you're taking a lower risk with a higher return profile. And many private investment managers and companies say, yes, this is that arbitrage. And well, is it actually? That's the due diligence process. So I just have to, one family office makes more aggressive allocations and has a higher IRR. If you look back 10 years compared to another family office, it doesn't mean the family office that was more conservative made mistakes. It means they had, hypothetically, a plan and a process, and they were going to take the flights that would work for them, and they weren't going to take the flights that they perceived as risky. Like, they understand they should, on the investment policy, they're not trying to hit the cover off the ball. They're not trying to hit home runs and triples. They're trying to hit a series of singles and the occasional double. And that works for many families. It doesn't work for others.
Well, good points. And again, we could go back and forth on the subject. And you hinted at one of the topics that I would go down. Part of it depends. Is the wealth creator, who's a swashbuckling entrepreneur that had success, is still active in the process? Then they're going to be, we can make the argument, they already hit their grand slam. Why don't they play it safe? It probably isn't quite in their nature. They're understanding how to even build more wealth. They need to take certain risks. But if I'm a generational family office and non-bloodline executives are running the family office, and I have boards and investment committees, you damn well know they're often going to play it very, very conservative. And I hear you, Warren Buffett, don't lose money. Rule number 2, remember rule number 1. But part of that's going to depend on a variety of factors, with distributions coming out of the family capital, with real inflation for the super rich, and other factors that interplay, and the complete lack of rising generation engagement. But moving on.
By the way, here's kind of, from a macro, almost patriotic, if that doesn't sound too strange, like rebuttal of Warren Buffett, is he's free riding. Like, someone's got to take risk on early stage companies, or the economy in the United States would be as stagnant as the economy in Europe. And we don't want that.
Well, you hit upon one of my strong talking points with some debates I've done in the last couple of weeks. Europe is incredible. Great people, great architecture, great food. What companies have arisen from there that have made it to the Fortune 500?
Report just came out, right? The Noted Economist. It just came out.
Yeah.
In the last 50, the companies in Europe that are worth over 100 billion euros, none of those companies was created in the last 50 years. In contrast, the companies in the United States that are worth over 1 trillion, so 10x euros, all were created in the last 10 years. And that's because, in contrast to Warren Buffett, someone's willing to risk a zero.
You nailed it. Now, yes, maybe Stripe and Anthropic could change some of that dynamic, but that's a challenge with European, broadly speaking, hierarchy and bureaucracy, and a certain stigma relative to taking a risk and failing that underlies an American spirit. So when I'm asked by families about investing in earlier stage companies and angel and venture, I tell them, likely you're going to beat it investing in the triple Q, but what makes America great, what makes Silicon Valley, and I could think of Austin and Boston and other hubs of great entrepreneurs, is I'm almost giving back to the country, hoping that some of what I do works out. But I think it's beneficial to society that we do support entrepreneurs. So I know I'm talking a little bit out of both sides.
No, but I totally agree. And to me, it's
true.
The way I would reconcile it is, like, if a family has achieved a significant fortune, I do think it's charitable is a strange word to use, but there's, like, you should allocate a certain percentage to early stage companies. And if you think you have the gumption and the contacts to do it directly, and you build the team to do it, that's That's great. I'm a huge supporter of it. Someone has to do it. Not everyone can be Warren Buffett, or else our economy will become more static.
100%. Sam, I got a question that I don't think you probably saw coming, but given that you also dabble in your legal work and estate planning, I think you're going to think, this is something to consider. Suppose, let's go with an older gentleman who either never got married or is divorced. So they're not going to have the marital exemption. They pass away and they're 40, 50, 60, 70% or more as an LP investor or even broadly in privates. Where is their liquidity going to come from to deal with the estate tax?
Well, if they've done good tax planning, if they have children, they have a significant percentage of their portfolios in irrevocable trusts that are not subject to the estate tax. They've set up trust earlier. They've gifted money directly to the trust, that then made investments. They did grant or retained annuity trust. They've done a lot of things. So there should be substantial. If someone is worth hundreds of millions or $1 billion and dies, and 100% of that portfolio is in their taxable estate, like someone should be sued for malpractice, frankly. So that's my answer. There should be significant irrevocable trusts that are in place. You could have a private life insurance or a whole number of different vehicles, so that it's not all in the taxable estate. With respect to the amount that's in the taxable estate, there does need to be a healthy percentage of liquids, because it's going to be taxed. Now, there is a very strong secondary private equity market for selling LP positions now compared to 20 years ago. In fact, one of my favorite private equity funds in which I'm an LP is called Klein Hill Partners. They really do outstanding work in buying LP positions. So, of course, they're trying to get really good deals, typically from endowments, not from individuals, but or estates. So it does if this is where I think having the tax advisors integrated in with the investment team can be very beneficial.
Which usually is one of the hallmarks you would like to hope of a single family office, both internally and potentially with external resources coordinating those efforts. I hear what you're saying. You are correct. Yet I think we'll both be a little bit shocked. Been around the world, know thousands of families. A lot of them do some of that initial planning, and then it kind of just, because it's not exciting, another year goes by, 3 years go by, 5 years go by, and it becomes a little dated. And you'll be surprised. You'll see $1 billion family with only $10 million of life insurance, with limited planning on gifting or discounting strategies or grats. And if they just would have been on top of it as conditions change, including their assets often in the last 5 years specifically going up, they could have addressed those issues. But shockingly, a lot of them fall far short.
And I agree, by the way, and fintech has been a huge category, right, of investment.
Yeah.
And for single family offices and multifamily offices, using tools like Attapar to combine all of your liquid and illiquid investments into one screen where you can filter by investor, be it a trust, or you can filter all sorts of ways. There's one of the founders of Attapar co-founded a company called Luminary, which is like legal tech, fintech. It's really interesting for saying, okay, should we be doing more grats? And a family uploads all its estate planning documents, trusts, wills, and it uses artificial intelligence, and then it gets synced up to Attapar or your other portfolio where you're tracking monthly NAVs, and can actually like recommend grats, for example, out of a trust. So it becomes a very powerful tool. And once that's integrated in with the financial software single or multifamily office use, it should materially reduce the probability of just estate planning languishing and not being looked at on a regular basis. It's also a way, forgive me for gender stereotyping, it's a great way to involve female spouses who want to make sure they're, thinking about their grandchildren and things like that, then as opposed to just investment returns.
100%. Luminary is a wonderful company. Vanilla also does variations of estate planning work. And if you have a real large portfolio of privates, mainly, I guess, as LPs, I'd also look at a company called Arch. Different than Archway, who's wonderful as well, but Arch is very focused and laser focused on private companies. So understanding the right technologies and tech stack in a portfolio of directing companies or private companies is very, very important. Sam, from your own perspective, are you more active in looking to have control of private companies or actually in many ways prefer non-controlling interest?
What works for me and my is non-control for a number of reasons. So I know as an attorney, I've been involved in co-founding a VC firm that does independent sponsor opportunities. Those are non-control. Myself as an investor, I'm an LP in with a number of alternative investment managers. Those are obviously non-control. Although in most cases, the investment managers control, but not in all cases. And then in directs, for me, it's always been non-control. So I'm not in a position to be buying companies myself. So I have kind of detailed diligence processes for non-controlled direct investments. But I think I know I'm pretty close to having a good playbook for control ones, but I wouldn't say I have it entirely. That's really like a private equity playbook for having a control investment. There are a number of key themes like governance that are over both, but a non-control has additional challenges for sure when you're when you don't make decisions on dispositions, on liquidity events, on strategic hires of the next CEO, et cetera. It's a different kettle of fish for sure.
Of course. And for those that maybe are more active on the controlling side, and it's deemed to be one of the advantages of having a single family office is control, privacy, and customization, and never underestimate, especially those billionaires. They kind of do like their control. But how would you recommend, and you're unique in terms of having lived through it, as well as being an attorney by trade, how do they structure their private investments? Do they set up separate LLCs? Do they do it as a holdco? Is there a preferred domicile, New Hampshire, Delaware, Wyoming, South Dakota?
So I think compared to institutional, and your earlier comment on, well, like the large private equity funds, they are catering to institutional investors. And that's true. That's where the money is, as the bank robber said, so to speak. So for single family offices who want to do control investments, they should be very thoughtful, of course, on structuring and tax. For example, if they're buying a company with transportation assets or other hard assets, that could generate significant accelerated depreciation and losses in the first several years above and beyond the cash flow. And it's a control investment. It's an exception to the passive activity rules under the Internal Revenue Code regulations. So that could generate significant tax losses that they could apply to their other investment income. So that's an example of why you'd want the investment to be held by an LLC. So if you're looking to buy a company, maybe you would just buy. It's easier to convert a C corp. There's a realization event, you just buy the assets and put them in an LLC. So look, Delaware still is considered a very strong place as far as strong judges and strong case law in addition to statutory law. We can mix it up a bit. I think the Delaware judge I'm going to use provocative language, with the benefit of 2020 hindsight, after Tesla had a 10x return after going public and thereby triggering all the stock options for Elon, she is threatening the golden goose of Delaware.
100%.
I mean, it's a shocking result to say we're going to go back in time to a time when all the majority of the shareholders and the independent directors approved this deal that required Tesla to perform at an extraordinary level to 10x in value after it was publicly traded, and the CEO is not receiving any compensation whatsoever, and say now with the benefit of hindsight, we're going to undo that 8 years later. And Elon, of course, has a little bit of a platform in social media And he's just saying, why would why would one incorporate in Delaware now? And it was a direct threat, a direct attack on the golden goose of Delaware. I was shocked just from a kind of a cynical, Delaware is in the business of being friendly to companies. And that doesn't mean you let them screw shareholders, but like I was shocked by that result because I think that was the exact opposite.
I completely agree. They made it a political situation. It's a grave concern, and it caused me and others that I know to hesitate and look to states like Wyoming, potentially South Dakota, maybe on the East Coast, New Hampshire. And I know they may have certain things that are maybe not as beneficial with a long history, but I don't know if that long history and bureaucracy and arguably becoming a political football, that made me very nervous about
and it should make everyone nervous. But on the other hand, if we're talking about control investments by a single family office, you're not worried about, kind of the Elon Musk Tesla stock option type of situation with public shareholder lawyers. And by the way, it was hilarious that the contingent attorneys, like what they had in mind for their compensation. So Delaware is still very strong, but that was and remains of concern. But for a privately held controlled company, I think it's less risky. And I would still go with Delaware right now. But that's you can have very good lawyers who can look at specific situation and advise the family. But so should it be a C corp? Should it be an LLC? And then it can be integrated into estate planning. If you maybe a certain percentage of the cap table is transferred via GRAT or otherwise to trust for the benefit of descendants. And you certainly should integrate the estate planning in prior to closing that transaction.
Of course. And talking a little bit about the classics of a holding company, and we have history with Warren Buffett, with others. And I've had a couple of guests on, one that Ram, where we did a deep dive into looking at the nuances of structuring a holding company, interwoven back maybe in rules in the 70s with banking and insurance, interplay for tax advantages. But one of the things that we dove into, and I probably don't want to do a super deep down the rabbit hole, but this is the nuances of holdcos and investing in private companies. How do you know how to intertwine net operating losses, how to utilize that in a holding company to offset other gains? This becomes a combination of art and science, and maybe points to your point that maybe many families just don't have the internal capability and resources to address these complexities, or honestly, are they really that complex? They could be learned. You could bring this internal.
Yeah, it depends on the situation. But in many cases, a holdco structure where you expect each underlying business to be profitable, I'll say make those all C corp blockers, and the holdco parent is an LLC. That could work. So you only do dividends out that you want to come out of. But other fact patterns are a family has a seriously cash flowing business and another business that is throwing off NOLs. So you'd actually want those to be LLCs in the same holdco. And so then the NOLs or the losses in one business will offset the cash flow in another. So it depends on the type of investments that are being made, and just have to structure. And of course, having flexibility, because sometimes you don't. Well, we thought both businesses would be profitable, but now we're in a different situation. It shouldn't be. If you have good planning, to me it's less difficult than the investing.
Yes, it probably is. And Sam, I know this next kind of question is not quite as applicable in your direct investing strategy, but in your experiences and those that you advise. Okay, if you're going to have controlling interest, you're buying into a company. I'd like to hope that you think that you're going to be better in systems and operations and marketing and sales, whatever it is. In other words, you're going to enhance bottom line. So how do you assess or work with a client assessing the current owner, management company, employees? And how do you potentially know how to bring in an operator that could enhance the value in the company, effectively at the end of the day, the bottom line? And again, we go back to, this is kind of an art and science.
I mean, this is private equity 101, right? It's okay. Their finances, they're not professionalized on finances. They're not professionalized on their sales, CRMs, like operationally reporting, like all of these things. We're going to put in better systems. Like this is like middle market private equity 101. And so like, do you have the team in place to do that? If you don't, then why are you doing control investments and buying companies? Like, wait, is the founder from who founded the company 30 years ago, is he just over and out, or is he heavily incentivized for the company and for the company to continue to grow? Like, who's going to be the CEO now? And so these are like key middle market private equity concerns. And I think if a family lacks like deep industry expertise, I would say the way to is invest in an independent sponsor. Or like one of my favorite investments as an LP is a group called Bowside Capital. That's a blind pool fund, but they only invest in lower middle market independent sponsor opportunities. And so their classic fact pattern is, okay, they're Bowside's allocating to an independent sponsor who's buying 60% of the business. The founder is retaining the other 40% and is highly incentivized for the company to really grow over the next 7 years. But like the operations definitely need to be professionalized, and that's part of the private equity independent sponsors playbook. And they've got those tools in place. And there are a number of very strong private equity independent sponsors in the lower middle market space now, because it's just so much cheaper to be an independent sponsor and not have to deal with all the compliance and the reporting as a blind pool fund is much more difficult. So there's kind of a compliance delta there, if you will, that very strong independent sponsors are saying, we either know firms like Bowside that invest in our specific opportunities on a regular basis, or we have a relationship with 5 or 7 single family offices. We've done well for those LPs, single family office LPs in the past, and we expect them to allocate to us in the future. And then as an investor, that's sort of a hybrid actually between a direct investment and you're being an LP, but not in a blind pool fund. So you can diligence the GP, and you can diligence the specific opportunity as well. So that's, I guess, I changed the subject a little bit to directly answer your question. Like for how a family wants to do control investments, and how do they assess whether a company has the systems and processes and infrastructure, or are they going to implement those, and that's how they're going to drive IRR. That's middle market private equity 101. And that's more so than, say, big private equity, which fairly or unfairly gets the reputation of kind of driving IRR through financial engineering, which maybe is more difficult now with higher interest rates. So I would say for a family office that's interested in middle market control investments, be an LP in blind pool funds and or independent sponsors, and learn and speak to them, and then say, do we want to replicate this ourselves?
Great advice.
And then like, it's not binary. You could say, okay, well, we wanted to put 10% of our overall portfolio into lower middle market private equity. We'll start at that entire 10% as an LP, but then maybe we'll migrate it over time to 5 and 5 with our own internal team. That would be a good approach, in my opinion.
And Sam, what industries as a private investor now do you find intriguing?
Well, I've always been interested in energy and infrastructure. My single biggest private investment is as an LP in ITE management, which is industrial transportation assets that cash flow very nicely, but because of the accelerated depreciation, there's a K1 loss. So as a tax-paying LP, compared to an endowment. It makes it even more attractive. It's a conservative investment. They're never going to hit the they're getting single after single after single, very robust risk control processes. To me, that's a very important part of my portfolio. I like transportation assets. I like infrastructure overall. I've done a fair amount of energy investing, which is both traditional energy, fossil fuel based, as well as alternative energy. Probably my single most successful direct private investment was into a working interest in a natural gas opportunity that ended up being the largest onshore well in Louisiana history. It was a great investment. I was willing to do it because I had a close relationship with the director and of the company and got to know the CEO very well and knew that I wasn't going to get screwed, at least from a governance perspective. And it was also tax advantaged because the amount of money that I put at risk prior to knowing that there was a resource in that well would offset ordinary income. And so it was really asymmetric risk reward as a result. So I do like energy investments. I like green tech investments too, with the right allocation. I've done some around industrial carbon capture, which is much closer to being commercialized than direct air capture, which obviously is the far smaller percentage of CO2 concentration in the air compared to industrial flue stacks. So I like energy and infrastructure. I'm looking at AI data centers now. I think that's a really interesting space. There's a big energy component to that, given how thirsty they are for energy, 10x traditional of the energy needs of traditional data centers. So I'm looking at a company now with operations in northern Norway, the Arctic Circle, which is non-intermittent hydro energy, so 100% renewable, but not intermittent, in stark contrast to solar and wind. And it's very well priced. So I do like the energy in that specific case. So I think AI data centers are a big space. It's a competitive space, obviously, with the hyperscalers and other companies like CoreWeave, but I think it's a really interesting space.
Of course. And you did hint at a couple of strategies over the course of our interview, but of course my audience is going to be very interested in basically how do you end up sourcing? How do you get deal flow in direct deals?
So I didn't say interested in a specific area. And then you just have to really nurture contacts over time. And it brings to mind like a vignette I had when I was being pitched to be an investor in a lower middle market PE firm once. They had that, it is banal, like the deck slide about proprietary sourcing in the funnel from 100 opportunities to only 20 get to LOI, and then further diligence down to one opportunity. We've all seen that deck slide many times. The proprietary sourcing. Then they had the next several slides were about this one phenomenal deal they did. And I asked, look, so how did you source this deal? What was your proprietary sourcing? Well, it was my college roommate. So now you could look at that two ways. Like the negative is like you don't really have proprietary source. You just got lucky that your college roommate did this investment, just founded this company. The other way of looking at it is actually he maintained relationships over 3 decades. And that's actually a positive comment. And where my freshman year in college roommate, I remember he's a nice guy, but I don't know what he's doing now. So if he was founding a company, I would not know about it because I didn't maintain that contact. So you have to say, okay, I'm interested in energy tech investing. And there are a number, I'm interested in carbon capture. Well, there's this firm called CO2 that sends out emails every week. And it's like a lengthy email. And there are a number of links to articles. Like you can learn a lot about companies in the space, but you have to put in the time and go to networking events. And you just have to put in time and network and be organized on your kind of CRM. And then subscribe to some of the daily emails. I've looked at specific deals. I was really interested in bovine methane emissions are like a material percentage of actually global warming gases. So I got a daily email of venture capital deals are funded. One was with respect to a company that has this plan to use commercially grown and scaled red seaweed, which can really mitigate bovine methane emissions. And I said, well, the lead investor has invested, a VC firm, but the round is ongoing. I literally reached out to the CEO on LinkedIn, cold called him, and then I was on Zoom with them 2 days later. So you just have to be proactive. And then the more one learns about an industry, you get more contacts and things start to go, instead of going uphill, they go downhill. So one should be especially wary, like when an opportunity comes to you, like, why am I getting this great opportunity? Why are they coming to me? Why isn't it going to a VC firm, or why isn't it going to a private equity firm? Like, always be skeptical as to why you have the opportunity if it's so phenomenal that it didn't go to a more obvious source, or funder, I should say.
Very true. As an example, when I was looking at RV parks and a little bit of a mini roll-up in New England, I simply subscribed for a couple of $100 to a newsletter that basically services most of the RV parks in New England. That gave me a list, that gave me insight, that gave me opportunity. When I looked at construction industry, I went to some of the trade shows. You meet people, but you got to get out there. You got to put in the work. Sam said, yeah, there's no way around that. In terms of our live audience, thank you, Sander and the Inspirer. Appreciate your kind words. Sam, we do have a question that came in from JW. Sam, what education, training courses, or books would Sam recommend for those interested in their SFO becoming more competent in direct investing in private companies?
Books on corporate finance, books on, I would, for a historic, like a really enjoyable read, I would actually read Barbarians at the Gate about
it's great.
The KKR's acquisition of RJ Nabisco. But I would say, if you're already an LP in private equity funds or other alternative investment managers, start asking them for their...
Hey, Siri. Oh, I'm sorry, Sam.
Start asking them for their investment memoranda. There's a lot of great information in there. And so be the type of LP who's friendly, who's constructive, that people at the GP want to speak to. And part of your diligence for looking at an LP allocation investment is say, I'd like to see from your previous fund, that made 12 investments. I want to see the investment memoranda and talk through why they made those. Now that's a tremendous educational tool. Now you have those investment memoranda. You're under NDA. You can't share those around, but that is a great educational tool.
Excellent. And JD, I'm going to add a little bit to that. And yes, it's going to sound a little self-serving from my perspective. I've been in the industry a long time. I know a lot of people. I'm very excited about my private club that I created at SFO Continuity. I have some great and incredible early 30 founding members, and I put together a lot of programming and a lot of content. Just this summer, my interview with Nathan Troutman, who basically helped to restructure Paul Allen and Julian Robertson's family office, active indirects, Sam today, and others that are upcoming. I simply have a lot of resources, both in person and digitally, and the opportunity for my network. Who are the attorneys in play? Who are some of the resources on sourcing and diligence? Who are some of the families that are actually active in those sectors? So sure, joining SFO Continuity gives you a head start for a relatively modest fee and puts you in a position where you're not bombarded by service providers and vendors. It truly is a private club dedicated to the exceptionally successful and their family offices. And as you could probably tell in my questions and my tonality today, I'm an extreme advocate of investing in private companies. Now, we could go into the nuances of controlling, non-controlling, when to use or be an LP, and we discussed some of that. So simply join. Go to angelorobles.com and sign up today. Sam, taking it. Oh, there's more questions. You're a popular one here, Sam. How do you go about learning from and working with other SFOs who have been successful in direct investing? That's part one of her question.
Is relationship building. It's because SFOs are an industry by themselves. So relationship building. And SFOs, of course, are always concerned that someone who reaches out is a Trojan horse. They say, "Oh, I'm a fellow family office," but then I want to look at deals together. But then the other shoe drops, and actually they're soliciting you for an investment or soliciting you to be a vendor of some sort. Like it's Trojan horse. Like it's a Trojan horse that happens over and over again. So if you want to, Angelo can be a great resource for introductions between single family offices. It's a warm introduction. Angela can say to the single family office, "I know person X, they're not going to try to sell you anything. They just want to have kind of potential peer-to-peer collaboration. But it's best to approach those conversations with, it's not just all in one direction, that we're looking at X, Y, and Z. Maybe we could collaborate, not like charging fees, but for club deals, that could be of interest." So speaking sometimes with people like Angelo as an intermediate, establishing relationships with single family offices, speaking to lawyers and other advisors. But it's just kind of investing the time and having a plan to have a good, put together a good list of peers.
And thank you, audience, for your questions. It's greatly appreciated. Very helpful. Many of you know that I do enjoy long form interviews, and I do enjoy, a little back and forth with the guest, like today, where we may disagree and it may get a little sparky, and going down some subjects which would not be applicable for today with Sam, but the work that I do for families geopolitically, economics, and investing, and challenging certain status quos and not looking to be quote unquote politically correct. I hope you all appreciate that, because I'm just not seeing others in the community that I think are pushing those boundaries, right or wrong, and having open and honest discussions that are longer form. On that note,
let's mix it up a little bit there, Angela, because I happen to agree with you on that. And so to be slightly provocative, I commend to your viewers the lengthy article in the New York Times recently on corporate governance at Disney, with Bob Iger, like setting up his successor, in air quotes, who was set up to fail because Bob Iger would never really release control, and his successor didn't really have a chance. And why did the board allow that? Why did the board allow a situation where there was always a problem with the successor? It's because the incumbent didn't want to give up control. So I do think I have questions sometimes about boards of large publicly traded companies, and they have to be constituted in a certain manner to have certain demographics, as opposed to saying these are the right board members who are going to be truly independent and have deep expertise running large publicly traded companies. So it does impact it. It's not a separate conversation.
That's a great point. And ironically, in October, I'm going to have a guest on who has been a board member of, I think it's 13 private companies. We're going to talk about these tough issues. And by the way, she's going to disagree with some of my comments on them. And that's okay. We mutually learn and the audience benefits. And she is going to transition into the value of family boards and families. So I got a lot of great content coming up. Some of it is going to be exclusive for my members, and some of it, they're definitely going to get first dibs before I more broadly release it. So simply stay tuned. Sam, another question. What are the top 3 mistakes that family offices make in direct investing that often causes them to stop or give up?
Well, apologies for beating a dead horse. The number one mistake is lying to yourself that you know what you're doing and you have a plan and a process. So maybe the less provocative way of framing it is family offices or ultra high net worth individuals making direct private investments without an overall plan and process. So you come into an opportunity and you're considering it in a vacuum. You can't do that. You need to have a comprehensive plan and process as to why you could potentially make this investment, what your diligence process is, and what's the appropriate check size within your overall portfolio construction and allocation. So it's kind of, and then so that's number one, is just have a macro plan and process, which certainly includes a detailed due diligence checklist and process, but that's not it. It's within the parameters, within the context of what you're trying to accomplish overall. I don't know. That's very broad, but all the mistakes would be, I think, leading mistakes would be because you didn't have an overall plan and process, and everything flows from that. Good.
No, that's very good. I'm gonna rattle off to you probably about 7 or 8 remaining questions that maybe we'll look to buzz through as much as buzz through we could, but I think they're very important for having a longer form, strong discussion on direct investing. And actually hinted at your last comment, Sam, what is the initial diligence? And this may be applicable a little more for a direct controlling investment. What is the initial diligence that you do leading or recommending to a client leading into a non-binding letter of intent and LOI? And could I make the argument, I don't want to simplify it, but really it's profit and loss year to date and looking back 3 years. If I'm buying into a profitable company and I believe in the thematic and structure of it, and it's a non-binding LOI before we dive deeper, isn't that enough to get rolling?
Well, I would say first, there always will be more opportunities than capital that can be allocated. So the expectation should be, I'm going to see a number of opportunities and have a number of conversations, and then a small percentage of those will proceed to the next stage. If that's not the case, like you're probably doing something wrong. So like if I bumped into someone at a cocktail party and they said look at X, and I looked at X, I'm investing in that. Like that gets back to not having a plan and process. So I would say let's forget about like non-binding LOI. Let's start with first have a conversation with the management team. Video conferences make it easier to do in an expedited manner. You don't have to fly, and you can get more out of a video discussion compared to a phone call. You can still get the most out of it in person. Have that at least video discussion. Hear the management team talk about the company or the opportunity, and then make an assessment based upon that. And then maybe in advance of that, you've seen a preliminary deck and you have questions to ask based upon that deck. And then you have that initial video discussion and say, well, am I prepared to sign an NDA? And like, don't just sign every NDA, right? Because like the idea of having all the hundreds and hundreds of NDAs that have
probably not a good idea,
right? Just like there should be a filter before you sign an NDA. And then like even like what's the NDA they send over? Do they have like a 10-year non-disclosed period that's way outside of industry standard? Like that's actually a diligence event right there. Are they realistic? Are there are they going to be difficult to deal with? It's like a small point, but it's a diligence point. Sign the NDA, get into the data room, and really spend the time before the next meeting, be it a video conference or in person, to really go through everything in the data room, the financial model, the historic financials, everything. And do you have the internal team to do that? Are you using external advisors? And then you have the next conversation with the group raising capital. And at this point, I would say I like the phrase as an attorney, it's like an amicable deposition, right? You're not in attack mode, but you're asking tough questions in a constructive and diplomatic and indeed amicable manner, but you're asking tough questions and you have a foundation of knowledge, just like a litigator has a foundation of knowledge in going through all the discovery prior to the deposition. You have a foundation of knowledge based upon having gone through the data room. And you really, you script out your questions in advance of that. And they may say, well, we'll come back to you on X, we'll come back to you on Y. You'll learn a lot in their substantive answers and then their process. So maybe there are a couple rounds of that. And then maybe you're saying, okay, we're going to sign a term sheet. And if you're the lead investor, or if there's another lead investor, presumably they've already signed a term sheet. And term sheets are almost always are subject to ongoing due diligence. Now, sometimes a company will try to limit the areas of due diligence, but to me, a term sheet should only have a very small number of binding provisions. One would be that confidentiality around the fact that you're under a term sheet. Company may want that, and it could be valid. From an investor's perspective, if you're the lead investor, you can't have them shop that term sheet and try to get better terms from someone else. So you need to have exclusivity to close the deal on the terms in the term sheet for 120 days or 90 days. Those terms should be, then the third one I'd like to have as an investor be binding is legal fees. Now, that may not be agreed to, but it could be worth the ask, certainly, so that your legal fees as an investor will be covered by the company, regardless of whether the deal closes. But those are the really, outside of that, the terms in the term sheet should not be binding, but you need to have exclusivity. You have to have that, or else what's the point? They're going to just they could shop the term sheet. So, and then now you do more due diligence, right? That right. Now you'll have more requests. Well, I want to learn about X and there's nothing on it in the data room. And you have to have your whole diligence process. And, to me, like a friend of mine who worked at a series of early stage companies, he said, it's like they say in real estate, Sam, like location, location, location. Like you're looking at investing in a company, it's management team, management team, management team. That was his comment. And so, okay, so what is the process for diligencing the management team? It could be like, I like to break it into competence and probity, competence and integrity. And and then competence has a whole series of subcategories, and so does integrity and maybe put integrity and transparency together. When I worked for the U.S. government for several years, I had a top secret security clearance with special compartmentalized information. And so when I was applying for that security clearance, retired FBI special agents, now independent contractors, went and interviewed some of my friends I had put down on, I know these people. And the first questions they asked were, who else does Sam know? Like what they were trying to do is get people who are outside my immediate circle who would give kind of franker feedback. Right. And so then they asked, has Sam ever not paid back money that he's owed? Has Sam ever done this? Did Sam have some criminal situation that didn't result in charges? But they've already gotten the names of people who will be like less friendly to Sam. And then they're going to go to them. And so like, if you're we're going to have background checks done on the management team. There's of course like the criminal stuff, and have they been involved in civil litigation? Have they been sued by investors? That's obviously material, and it happens all the time. But then, they'll say, well, you can speak to investors at my previous company. Here's, contact person X, contact person Y. What they're really thinking is contact Sam, but please don't contact Angelo. We're not going to give you Angelo's contact details. So you as an investor may want to say, okay, I'm going to ask Sam, who else invested? Oh, Angelo. All right. Well, do you have Angelo's contact details? And like really build it out. So you have a comprehensive diligence process for assessing the competence and integrity of the management team. That would be part of an overall process.
And Sam, there's a popular private equity investor and commentator on X. Her name is Cody Sanchez. She noted that really two things matter in kind of the negotiation phase, and I'm assuming mainly to be a controlling investor, effectively price and terms. And as the investor, I'm probably not going to give the seller perfectly what they want in price and terms. If there's one of the two that I wanted to most control, it's probably going to be the terms. Agree or disagree?
You mean the non-economic terms?
The terms in general. For instance, if a business is $10 million, I'm going to give you the $10 million, but they're on my terms, seller financing over 30 years. You're probably not going to take it, but I'm giving you your price. So that little bit of that back and forth, that negotiation with a specific team or a seller on, again, the price you pay, or more importantly, the terms that are dictated. And I think I agree with her that I think terms are actually more important.
Yeah, I think you can't look at any in a vacuum. Like, so the overall valuation is important. And does it move a little bit? Does it move a lot bit? I mean, I've seen like major disparities between bid and ask, right? And right. So, and then people can endeavor to mitigate that by using preferred equity structure or participating preferred, where the investor gets the first 2x back and then it's prorated and there's not a catch up to the common shares. Like, there are all sorts of structures one can employ that maybe subtly, so the seller can kind of get the win on valuation, but you've mitigated it to some extent. So on the terms, There's a lot there on terms that are not just
Yes.
economic, but can impact economics. And it all flows from the due diligence, right? Like having reviewed every material contract to which the company is a party. And if it's a big company, that's a lot of contracts. So like you're going to have a law firm engaged to do the due diligence on those contracts. By the way, AI is such a powerful tool to assist in that now. And it's even now compared to 12 months ago. So is really, I would say, like having really be dialed in on the due diligence and really understanding the company and its strengths and its weaknesses and its challenges and its opportunities, then will position one to do the best negotiation on economic and non-economic terms.
And Sam, I guess part of it depends on the industry, the scenario, and getting comfortable with the current owner, management team, and really even key employees. In other words, what's going to be an earnout? What kind of seller financing is the seller willing to take back? And admittingly, this may be for more smaller to small mid-sized businesses, not the big giants that the private equity or the larger private equity firms are going for. But here's the key point and question. Like, I probably don't want that owner to, after 1 year, go and start a competitor. Suppose someone from the management team wants to do that, or suppose it's driven by one incredible person in sales and I can't get them to re-up on a contract. Now, this relates, didn't I hear correctly, that a couple of months ago, it appears to be harder and harder to enforce a non-compete agreement. Now, maybe with the current owner selling to you, that's different, but with the key employee, it seems like things might have just got harder.
So I was last summer looking at a private credit firm that is really outstanding as a prospective LP, and like the CIO, like I loved his personality because he's very smart and he was so focused on investments. Like his interpersonal skills like weren't as great, but like who cares? Like for a surgeon, like do I care if a surgeon has a great bedside manner? I care more about whether they're going to do it. Am I going to wake up from the surgery? And so this guy, the CIO, like wasn't a sales rep. He wasn't investor relations, but he really knew his business. And then I asked him about, like, he said he had previously done like 60 private credit investments and like, well, 3 that went upside down. And like, he wanted to talk about those 3 more than the 47. He was still obsessed with a mistake that had been made 10 years ago. And in this one case, the mistake was exactly what you're saying. They did a credit investment. There wasn't a sponsor. They had good equity warrants, and it was like within like HVAC, which is a big private equity.
Very trendy lately.
And then like the top sales rep left with the entire like customer CRM list, and then like within 9 months, this HVAC firm had like lost a lot of its company.
Yeah, bye-bye.
Right now you say, well, like we're going to prevail on litigation. Like that's not a good strategy. So the painful lesson learned, it's difficult. You have to establish a relationship with who are the key personnel. First of all, you have to make sure like CRMs like that like have to be like literally and figuratively in a vault and not available to people who don't have an equity stake in your business going forward and are incentivized to grow the business. And understanding divisions between like the 75-year-old founder and like the 50 to 40-year-olds who may be his blood relatives or may not, who are doing the work and are driving the business. So you really have to understand that and incentivize. Everyone should be incentivized with equity. I'm not a huge fan of earnouts. I think earnouts are great business for litigators because they often end in litigation. Because like, the earnout of a company that's being acquired, it's like, well, you have to hit X, Y, and Z. But then if the majority owner can like reduce the probability that you hit X, Y, and Z within the next 8 quarters, it's like it's just a recipe for future disputes, unless they're very clearly written and should be a smaller percentage of the overall payment for that management team. For that reason, I'm not a big fan of earnouts. I think giving the right people equity and having them incentivized to really grow the business going forward, and like grow the pie. Don't try to dominate the percentage of the pie. Be very thoughtful about your ownership amount, but incentivize the right players who may not be the legacy players that built the business up to that point.
And Sam, someone that we mutually know, I'm not going to mention their name, had this comment. Audience, don't get mad at me. It's their comment, but I think there's a grain of truth to it. Basically, that comment is honestly, do most family offices really know a good deal when they see one? Now, his perspective was a little more on we're not going to have complete information. We need to move in 3 or 4 weeks. Angelo, I approached a fellow single family office. Oh, well, non bloodline executive. We got to go to the committee. The committee just met. We can't call an emergency meeting. No, I'm not going to directly reach out to the principal. There's lots of layers of hierarchy. Now, sometimes that helps in terms of being careful not to make bad decisions. But this goes back to a subject that we discussed a little earlier. If it's too hierarchical and bureaucratic, too conservative, and the family is more and more removed from the process, and there's layers and layers, I sometimes really don't know if many family offices really do know a great deal when they see one.
It happens all the time. Don't know, invest in something that's not actually a great deal, or pass on something that actually you should have invested in. It gets back to having a plan and a process. You don't look at any opportunity in a vacuum. And I think it's perfectly legitimate for a family that's made a fortune to say, like, we're not going to do like quick turn opportunities, even though they could be amazing. That's just not what we're going to do. We've hired a CIO. The CIO knows that his number one priority is not to lose this money, and he's incentivized as such. So he's going to have a slow, methodical process. Now, in that type of family, it's probably should not be doing direct deals in any event. They should just be an LP in alternative investment management partnerships, and have public securities of different types. So it really depends. Like it's like every family, happy family's happy in the same way. Every unhappy family is unhappy in different ways. Like single family offices are obviously not a monolithic category. And if a family doesn't know whether it's a good deal or not, that's a comment that they shouldn't be doing direct deals. And these are hard categories. Like we don't have the benefit of hindsight when we wire money. We just don't. Like the hindsight comes later, based upon experience, positive and or painful. So I don't know. I'm meandering a bit.
And Sam, you're going to understand that when making a minority investment, sometimes through an SPV, you're not going to have a complete data room. You're not going to have complete information. There is some level of risk here. Now, I could argue there's a variety of factors to help mitigate that risk. And one of the ways is simply limit your exposure by your allocation, where, God forbid, the 75 basis points of your portfolio or 1% that you invested goes to nothing. You easily live to fight another day. But the exponential hopeful return is worth some of that risk. How do you make decisions in non-controlling investments where you may be going through an entity like an SPV where you're not going to have complete information?
Okay, well, first of all, I would say, like, for a large single family office, let's say hypothetically that has $2 billion under management, I don't think it should be putting 75 basis points into any direct private company. That's a big allocation. I think maybe say we're going to allocate 1% to private direct companies for non-control opportunities, and then take that 1%. It should be 15 or 20 separate positions. So, but that's my specific risk profile, and it's not for everyone. But make a witting decision on the overall portfolio construction and allocation, and then look at a specific opportunity in that context. And the SPVs, they are popular. I've been involved in some. And for the same kind of lower compliance than a blind pool fund. But the SPV should have a data room. They've done all this due diligence. They should have a data room. They're earning a 2 and 20. They, which could be a one-time, management fee and then the carried interest. They should have a data room. And so you set up for investors that's based upon the due diligence they did into the operating company. So you should learn a lot in that data room and have multiple opportunities to ask follow-up questions to the GP of that SPV.
And a broad question, Sam, I would say broadly speaking, investing in privates comparative to VC where you're buying on hope. And again, the entrepreneurial spirit, I get it. But it's much easier to buy into profits than to build profits. Do you generally, in more of the private equity investments, look to buy into an existing quote unquote profitable business? Or do you actually like the potential of turnarounds, even though that comes with risk? And whether you, as a direct investor or your client, has the internal people that understand turnarounds?
I haven't done that much restructuring investing. I know there's some great hedge funds that do special situations for distressed publicly traded companies buying debt. Could be a debt to equity play. In many cases, those GPs of special situations hedge funds have a legal background because bankruptcy law is so esoteric that it's a real advantage to have that background as an investor. But I haven't really done those type of restructuring investments directly or as an LP. Obviously, like there's some very successful restructuring hedge funds, private equity firms out there, like Elliott Capital, Paul Singer.
Of course.
So I don't know. Does that answer your question, Angelo? Sorry.
No, it does. There's very few that really are experienced and necessarily do a good job on turnarounds. Sam, I absolutely could talk to you for hours and hours, but I do want to be respectful of your time. We've already went ballpark about an hour and a half. Why don't I give you a chance in talking to fellow peers and families to give a little bit of a close on a conversation about direct deals, aka private companies. And for those that may have an interest in reaching out, whether it be learning more from your legal representation to your experiences as a trustee and investor to co-investing opportunities, give a close and how could they reach out to you?
Well, going in reverse order, anyone should feel free to email Angelo and he'll put you in touch with me. Would love to chat. Always want to meet new people. And from my opinion, which is of course subjective, is I really enjoy doing the private direct investments, but I have to be disciplined on the portfolio construction allocation, and I really follow a diligence checklist, including the management team and governance. Like the number of wild fact patterns I have seen. And corporate misgovernance in privately held companies that are doing really well. It's kind of insane. And I feel like I should teach a law course on that. So it's always good to have groups together that can look at opportunities and collaborate and share. And Angelo can be a great kind of mediator and platform for people to meet. So it's exciting. Don't lie to yourself. Have a real plan and process in place, and don't look at any opportunity in a vacuum. That's what I would say.
Excellent, Sam. And everyone, I'm Angelo Robles, the founder of SFO Continuity. That's my private membership club, host of At Family Office and Family Office TV. My life is dedicated to family offices, specifically really single family offices. I always talk about obsession. And obsessions sometimes have a negative connotation to some, and they could be when it consumes your life. To me, it's been a tremendous joy, my obsession in the world of great wealth and single family offices. And the area around direct investing, no matter how we twist it, I find incredibly intriguing. I've been active myself. So these are things that I do understand, and I've learned so much from Sam and so many others as real direct investors out there and in my travels around the world. Yes, I am an extreme advocate of considering quote unquote being a direct investor. I'm probably a bit more of an advocate, and I know it's way more work, of being a direct, often controlling investor. But if that is something where you want to engage that rising generation, that is the way to do it. And there's way more complexities than we had a chance to bring up today. There'll be other conversations this fall into the winter where I could talk to some generational families. Hopefully they're willing to be more public, but some may be more private for my members only on these subjects. So like I did state earlier, I hope you do go to angelorobles.com, look into membership. You could always reach out to me, as Sam noted, Angelo at angelorobles.com. And my platforms that give a pretty lot of free content on YouTube are at Family Office. That's my baby. I've owned it since YouTube came out practically, and at Family Office TV. I do have newer platforms on Apple, Spotify, and Rumble, and some of them are going to have unique proprietary content. They're all free, so why not subscribe? But the members get real-time access, interaction. I literally looked at something recently. Since I really launched SFO Continuity in full this past April, heading into April of 2025, I will have done over 100, that's my best guess estimate, over 100 digital and in-person programs around the world. I am extremely active, often 2 or 3 private programs in person a month. And as we approach the winter, Florida, LA, and maybe even Jackson Hole, my beloved Jackson Hole is going to make its way into some in-person gatherings. And that's where the connections really matter. Now, those of you that are watching this live and not on a recording, and Sam, what I find interesting, and kudos to you, is it's extremely rare that you do a live program and after 15, 20 minutes, the audience constantly increases. Usually things pull them away and the audience goes down. The audience is almost increasing minute by minute, shockingly, even in my close. But those of you that are listening live, and here's a key parameter, are a direct investing family member or a single family office executive. I am in New York City this Thursday, September 12th. I'm hosting a breakfast at 9 o'clock for a very intimate group of primarily my members. But occasionally, I do make things for 1 or 2 guests a little bit more open. Now, again, I love many of you. You're awesome. But please only reach out. One, if you're legitimately available and can make it, and you have to be an investing family member or an SFO executive. I have capacity for 1. And by the way, these are not 15, 20, 25 people breakfast. Those are awesome too. This is really a private or an intimate roundtable of like 6 or 7. And we go around the table, simply including me, sharing a little bit of economic update and ideas, and often kind of have to throw out an investment strategy. So it truly is peer-to-peer. And if you happen to be listening live and would like to be a part of it, simply email, DM, or reach out to me. But you are getting a flavor of the value that members get, and really joining and going to angelorobles.com and immersing yourself in all the activity and my obsession in what I do and my connections in people like Sam and many, many others. I know we could be of value. On that note, Sam, thank you so much for being very, very generous with your time. Audience, I appreciate all of you. I hope you enjoyed it. Have a wonderful day. Thank you.
Thank you, Angela. Cheers. Bye.
Cheers.